Hello, my name is Demario Stanley, and I'll be the facilitator for this morning or this afternoon. Today we're going to cover some mortgage assistance programs that will help you with your current housing situation. Again, it's very important that you pay attention to the slides. At the end of each slide, at the end of the PowerPoint, there will be some contact information for you. Or if you have more direct questions, you can actually email me or give me a call, and I'll respond to those questions as soon as possible. So if you would, this PowerPoint will take maybe 30 minutes or so, but it will give you complete detailed information regarding your housing options and which programs you may or may not be eligible for and how we can assist you with applying for those programs. All right, let's get started. So to begin, we're going to cover the North Carolina Foreclosure Prevention Fund. That program in itself is ran through our state agency, and then we have the Make a Home Affordable program, which is a federal program administered by the U.S. Treasury, which your servicer may participate in. All right, so we have, again, understanding your options. You have the state program. State program, again, is the North Carolina Foreclosure Prevention Fund. The universal name for it is called the Hardest Hit Fund, or you may see as HHF. Again, this program is geared towards helping individuals who, through no fault of their own, have some type of job-related hardship. This program is the only program that can actually help you make your mortgage payment. And then we also have the federal program, which is the Make Home Affordable plan. Again, the federal program is eligible for homeowners when they're looking at trying to obtain a loan modification of some sort, and that's actually adjusting the terms. The two biggest differences between the state program and the federal program is the state program is temporary. It's almost considered like a Band-Aid, if you want to say, because that program is going to run out eventually. That program is the only program that can actually help you make mortgage payments. And with that, being able to help you make a mortgage payment, the program will cover those payments for a certain period of time, and then it will end. But the federal program option, that's where your terms can actually be adjusted or changed as far as reduced interest rate, the payments being altered, some of the loan possibly being forgiven. That's more of a permanent situation for you, where you're looking to have a more permanent positive outcome. Then you also have internal options. Internal options are structured around your investor who actually own or guarantee the loan, i.e. Fannie Mae, Freddie Mac, FHA, USDA, VA loans all will be considered as separate investors. So you have a bank who services your account and the investor, of course, who ensure to guarantee the loan. So based on the investor guidelines, we'll determine what kind of internal options they may offer, which are totally separate from anything else. Okay? And then, of course, the most important is the homeowner. You must be resourceful when you're trying to obtain some type of workout solution with the lender or working with any outside agency. You always want to be dedicated. If you can, you always want to continue to try to make mortgage payments. The fewer number of payments you're delinquent on your mortgage is always a reflection of positive outcomes, as opposed to not having the money or not trying or attempting to make any payments. So at any point, if you can make a payment and your lender is still accepting payments, you want to make sure that you're making the payment. Okay? So of course we list certain things on here as far as adjusting your W-4s, roommate, carpool, coupon, donating a kidney if you need to get some extra income. That's a joke. But again, just please make sure that you are being resourceful and you're using your money wisely, and continue to try to make mortgage payments if your mortgage company is allowing you to do so. All right, so we're going to get started. First portion of the PowerPoint is going to cover the North Carolina Foreclosure Prevention Fund. We're going to specifically talk about the mortgage payment program. Again, this is the only program that can make your mortgage payments for you, where the state will take over your mortgage, actually just making the payments. You'll still have a first mortgage with whoever your first mortgage provider may be, and they're just going to make the payments on your behalf. And so now we're going to go ahead and get started and go over some of the qualifications. So why was the program actually established? Again, over the past few years, North Carolina was hit hard with the economy. So The U.S. Treasury is actually the ones who created the program. The purpose of the program is to actually help stabilize housing markets and prevent foreclosure. So the funds were allocated by U.S. Treasury. The funds were distributed. The program itself, the Economic Stabilization Act back in 2008, also known as Troubled Asset Relief Program or TARP. The state of North Carolina received almost $500 million, $482,781,786 to be exact, was how much money the state was given by our U.S. Treasury. In return, this program was developed to specifically help individuals primarily dealing with a job-related hardship due to no fault of their own. As you see on here, back in 2009, our state's unemployment rate was above 11%, and this is the main purpose or reason why the U.S. Treasury decided to give us this allotment of money to help those individuals who are dealing with some type of job-related hardship due to no fault of their own, to help them while they're searching for work or they've experienced a hardship and now are back working and just need some assistance to get back on their feet. Some of the program basics. The North Carolina Foreclosure Prevention Fund, again, the program we're going to discuss is the mortgage payment program. It offers assistance to all North Carolina homeowners who, through no fault of their own, have experienced some type of financial hardship, which it may be divorce, furloughed income, or reduction in income due to job layoffs, military retirement. You could be taken out of work due to a serious medical condition, also due to a death of a co-signer or a co-borrower on the loan, which would mean a reduction in your household income as well. So there's several different qualifying pieces that you may that can get you qualified for the specific program, which we'll go over in the next couple of slides. So, program basics. To participate, do you have to be current, delinquent, or you may be in foreclosure? So it doesn't, as far as your current status, could be either one of the three. So you may be current now, you could actually be delinquent a couple months, or you may actually be in foreclosure with your lender. Regardless of your current status, you still may be eligible to apply for this specific program. So in some situations, you might have heard that you have to be delinquent first. That's not the case here. You can be current never late in your life. As long as you meet the basic eligibility pieces, then you may be eligible for the program again. So for those who do qualify for this program, our state agency, North Carolina Housing Finance Agency, will provide a zero interest rate loan up to $36,000, which can cover your mortgage for up to 36 months while you search or train for a job. Now, the terms of the loan will be discussed later, and however, it's up to $36,000. Doesn't mean you're going to automatically qualify for the max amount. There are, again, terms and eligibility pieces that come into play, which will determine how much of the loan amount and how many months of assistance that you may qualify for. So there's three types of assistance. You may be eligible for one-time assistance, which can bring your mortgage current. That's for individuals who have experienced a job-related hardship but now are back working and just need help to get back on their feet. Short-term assistance, again, is for individuals who are only working part-time or unemployed, and they can qualify for short-term, which is an 18-month program. And then you have long-term assistance, which is up to 36 months. And that program is based on you being enrolled in school. And so if you are enrolled in school trying to retrain for a new career, then it's possible that they may actually pay your mortgage for up to 3 years while you're actually enrolled in the program. So here's some of the terms of the loan. The funds cover all mortgage expenses, meaning your first mortgage, the funds will cover that. It'll pay your first mortgage. They'll also pay any second mortgages or home equity line of credits that you have attached to your primary residence. Homeowners insurance and property tax will also be paid, along with homeowners association dues or expenses. So any mortgage-related expense on your primary residence, first mortgage, second mortgage, home equity line of credit, taxes, insurance, or HOA expenses will be covered through this specific program. As you see, the next bullet point, this is a loan. However, if you follow the terms and conditions, it's possible that you will not have to pay any of this money back, which we'll discuss later in the slides to know exactly what to do to avoid that. The loan itself is 0 interest, so they're not charging you any interest on the money that they are paying for you. Just as a reminder, remember, they're not replacing your current mortgage company, and they're not altering any of the terms. This program does not do that. This program only pays the payments for you. That's it. All your payments are deferred through the term of the loan, which means as they're making mortgage payments to your lender, you are not required to make any payments back to our state housing agency. If you continue to follow the terms and conditions while you live in the house, then you also will be forgiven of those payments, which means it could possibly be a free loan that you receive if you follow the terms and conditions. Just like, again, payments are all deferred through the entire term of the loan. If you follow the terms, you can avoid having to pay any portion of the money back. It's subordinate to your current mortgage. As I stated earlier, it's not replacing any of the mortgages that you currently have on your primary residence now. Your first mortgage is with Bank of America, and let's say you have a second mortgage or home equity line of credit with Wells Fargo, you still will have the first with Bank of America and your second with Wells Fargo. The only difference is now our state agency, the money that they're paying, they're just taking that money and paying it directly to Bank of America and the Wells Fargo for you. That way, you can remain current, and it keeps you in the house and gets you out of foreclosure. The loan itself is forgiven after 10 years. So 10 years from the date you sign the loan document is when your forgiveness period actually begins and ends. The 10-year period, again, starts the day you actually sign your closing documents or your loan doc. This is a loan process, so you will sign loan documents. If you're approved for the loan, then you sign your document. 10 years from that date, the loan is totally forgiven. Within that 10-year time frame, if you follow the terms and conditions, then you will not have to pay any of the money back. All right, so now let's get to the eligibility requirement. So how do I determine if I'm going to qualify for this program that's going to help me make my mortgage payments for me? All of the underwriting is done with our state housing agency, which is NC Housing Finance Agency. They are the underwriters there, handle all the processing. The way this process actually works is you, the homeowner, will not have any communication or contact directly with our state. All communication flows directly to my agency, the Center for Homeownership. Underwriters will contact us regarding any type of information they need, and we will in turn pass that information on to you. So we are your point of contact throughout this entire process. But what I have here are some of the basic underwriting criteria that our state is looking for to determine if you're going to be eligible for the program. This is an all or nothing, so you can't have one or two and qualify. You must meet all eligibility to be eligible for the program. So the first thing they're going to look at and consider is, do you have a qualifying financial hardship? They're very specific about what qualifies you for the program. As you see on here, unemployment is the most common and it's the easiest one to use. Underemployed is a second hardship reason. Temporary medical conditions is a third. Divorce and separation is a fourth. Death of a co-borrower is a fifth, and there's one that's missing, which is military retirement. We will go in more detail on the next slide explaining that further for you. Second thing they're going to look at is once they've determined that, okay, you now have a financial hardship that will qualify you to apply for the program. The next thing is, do you display a need for the program? Has your income been affected enough to show that you no longer can afford your mortgage? They use 25% housing to debt ratio. The only thing they're looking at is going to be your mortgage expenses. Nothing else comes into play. Groceries, car payments, medical expenses, none of that matters with the ratio. All they're looking at is your mortgage payment in relation to your gross household income. And if that is greater than 25%, then you'll be eligible. So now we've determined you must have a financial hardship. The next thing is, do you have a need for the program, which almost everyone meets the need qualifying percentage, so that's generally not a problem. The third point they're going to look at is your payment history prior to the hardship date occurring. So why are they looking at the payment history? Simply because they want to see, were you even able to afford the mortgage before you had the job loss? The good thing is they're only going to evaluate you for a 6-month window. So if your job loss was January 1st of 2014, then they're going to evaluate you from July of 2013 through December of 2013. That 6-month window, they're going to review your payment history and determine, were you able to maintain the mortgage payments prior to your hardship date. You can have a 30-day, but you cannot be greater than 2 months delinquent during that time frame. Again, the payment history is only based on that 6-month window prior to the hardship date, not what your current status is now. So you can be greater than 60 days delinquent at this date and time of application, but if you were 60 days delinquent within that 6 months prior to the hardship, then you may be disqualified. The next thing they're going to consider is, of course, you must be the homeowner. You must occupy the property as your permanent residence, and you must live in the property. Your name does not have to be on the loan as long as you have ownership rights in the house and that your name is on the deed. Next point is the property must be taxed as real property. They will allow mobile homes and manufactured homes as long as it's taxed as real property. Now, these are just several of the underwriting criteria. There's a couple more that the underwriters will look at, which I'm not going to go over in more detail. Again, this is just some basic informational points I want to cover with you so you get a general idea of what it's going to take to qualify you for this program. Again, at the bottom where you see the financial hardship can date back as far as January 1st of 2008. They actually give you over 5 years to experience one of the top hardships that we discussed earlier. So your hardship could have occurred, or you might have had a hardship, one of the hardships that occurred back in 2009. You may be eligible using that date. Again, as long as the hardship occurred after January 1st of 2008, then you may be eligible. So you could very well easily have 3 hardship dates where you've been unemployed every year since 2008. Each one of those dates is a qualifying piece for us. So we can use one of those dates to see if you can meet eligibility for the program, and so that's very important. All right, so here's the eligible financial hardships in detail. So the most common is unemployment. With unemployment, they're looking to see, did you get unemployment benefits? Remember, the program is underwritten based on your job loss being no fault of your own. So if you are working as a W-2 employee and you lose your job and you did not receive unemployment benefits, then it's determined that your job loss was your fault and you will not be eligible based on unemployment. If you worked at a position and you did receive unemployment benefits, then yes, you may be eligible. Also, if you work for a company that did not pay into ESC insurance, you may also qualify if you can get a notarized letter justifying that your job loss was due to no fault of your own. Now, again, unemployment is the most common. That's the most frequent one. And again, that's the easiest one to use to get you qualified if you were laid off from your job and if you received unemployment benefits. The second, unemployment and furlough, is mainly structured for self-employed borrowers. So if you're self-employed, you also may qualify for this program if you can document with your tax returns that you've been self-employed and that you had a reduction in your income, or you had to close your business down due to the recession or for various reasons. So again, if you have documented information, mainly your tax returns, that can justify that you had a self-employment business, and during the time from anywhere from January 1st of 2008 until now, then you may qualify. Third point is illness and medical. Illness and medical, you have to have a doctor's note to be able to show that you were working and you were taken out of work due to a medical condition or doctor's care. The doctor's note does need to be on letterhead, and again, it needs to justify that you were working and that the doctor took you out of work, not voluntary, nothing voluntary where you just decided to leave work because of a medical situation. Death of a co-borrower is actually structured as a two-part piece. The surviving party who still lives in the home must also have an employment-related hardship. What that means is if you are married and your spouse is deceased and you were only working part-time or unemployed or a homemaker, then you may be eligible for the program. If you were married and you were working full-time at the time of the death, then you would not be eligible. The same thing goes for divorce and separation. Divorce and separation, the spouse leaves the home, you have documented proof of the divorce or the separation agreement. At that time, if you were working full-time when both of you divorced or separated, you would not be eligible using divorce and separation. However, if you were only working part-time or unemployed, then you may be eligible for the program using divorce and separation. And military discharge is the last point to possibly qualify you for the program. If you've been in the military and been honorably discharged out of the military anytime since January 1st of 2008 until now, then you may be eligible for the program. So first and foremost, to determine your eligibility, you must have one of these qualifying hardships as I explained. And as long as it occurred after January 1st of 2008, then you may be eligible for the state program, which again can actually make your mortgage payments for you. The state program is the best option that's available now because it actually relieves you of that financial burden and can put you in a better position financially. All right, so remember the second point where we expressed the 60-day rule as far as being delinquent on your mortgage prior to your date of hardship. On this example, what I want to show you is how the underwriters review your payment history. So here under column B, under the second section where it shows Mortgage Lenders Incorporated, that is the mortgage trade line when they pull the credit report. So what's going to happen is the underwriters will review your credit report. This program is not based on credit score. They only look at your payment history. You can have, your credit rating does not matter in the sense as far as being able to qualify for this program. Now, but what they are going to look at is how you paid your mortgage before the hardship date occurred. So under Mortgage Lenders Incorporated, if you look at section column B where it shows reported, it shows us that this loan last reported December of 2010. If we follow all the way to the right under section K where it shows historical status, that 4, which is checked right here, represents that December of 2010 date. Now, moving from the 4 back, that is actually 12 months of payment history. So we know this is December of 2010. This is January of 2010. This 2 is December of 2009. This 1 is January of 2009. So we could count January of 2009 here. 12 payments out will be December of 2009. Start again in January of 2010 to December of 2010. What the numbers represent is your payment pattern. A 1 means current. A 2 means a 30-day. A 3 is a 60-day. A 4 is a 90-day. What you don't want to have within the 6-month window prior to your hardship date is anything greater than a 2. So for 3 and above, will disqualify you. In this example here, if we knew that Mr. Smith, or let's use Mr. Smith as this gentleman, we know that we're going to say he lost his job in December of 2010. So we automatically know that the 4 represents December of 2010. And what we would have to do is count backwards 6 payments. And if we count backwards the 6 payments, we automatically have a 3 right here, which is a 60-day in November, which would disqualify us. So he would not be eligible for the program because he was a 60-day status within the 6 months prior to his job loss, which we said was December of 2010. Now, let's go back. So let's look at this same example here. Under this same example, what we have is, let's use a different hardship date. So let's say the same Mr. Smith lost his job in December of 2009. I'm sorry, which is the 2 right underneath the 4, which means he was a 30-day in December of 2009. But if we count 6 payments back, which is 1, 2, 3, 4, 5, 6, we have no 3s or greater in that 6-month window, which means the worst payment history he displayed was a 30-day. Mr. Smith will qualify if he had a hardship date that occurred in December of 2009. So this is why it's important that you remember when your dates were, as far as how many, if you had multiple unemployment scenarios. So in this case, if Mr. Smith was laid off twice, let's say he was laid off in December of 2009, he found a job sometime in 2012, 2010, and then lost a job again in December of 2010. So he had 2 different hardship dates. We could use December of 2010 or December of 2009. If we use December of 2010, he would not qualify because it showed that he was a 60-day within the 6 months prior to his hardship date. If we use December of 2009, it would show that Mr. Smith would qualify because he was worst case within the 60-day the 6-month window, was he was only a 30-day. So it's very important that we choose the right hardship date. All right. So the third major point is, do you have a need for the program? Again, as I stated earlier, the only expenses they're considering are mortgage expenses. So in this example, Mr. Jones has a first mortgage payment of $1,000. His taxes and insurance escrowed in is $1,000. Has a second mortgage or a home equity line of credit, let's say for $500 a month. He also pays homeowner association dues for $800 a month. His current gross monthly income includes $2,000 from unemployment benefits and $3,000 from his spouse. So his gross household income is $5,000. So how they determine you have a need for the program is they take your mortgage expenses, which you see down at the bottom, divide it into your household income, and it gives us a percentage. 32% is greater than the 25 mark that we need to reach, which means Mr. Jones will qualify. So it's very likely that every client, most of you will qualify for the program based on a need basis. But you must have all the eligibility pieces, meaning the need for the program, the payment history prior to the hardship date, and must have an actual qualifying hardship reason that will qualify you. So now, since we've got an understanding of the underwriting criteria, let's talk about the types of assistance and which type would you be eligible for. So you have short-term assistance, which is also called job search. Job search is 18 months, meaning if you meet the eligibility and if your current situation at the time you're applying for the program with our agency is you're not working or you're only working part-time, then you can qualify for 18 months of assistance up to $36,000, whichever one comes first. So if your mortgage payments are only $1,000 a month, then you know you're going to only get 18 months of assistance. You're not going to get the full $36,000. That's how you're going to be able to determine which type of assistance you're going to be eligible, as far as being eligible for. One thing is, remember, the goal of this program is reemployment, so that way you will have the ability to resume mortgage payment. So again, this program is not permanent. It's something that's going to just help you get on your feet, make some mortgage payments for you to give you time to search for work, so that way you will have the ability to resume payments and take back over when this program ends. Long-term assistance is called job retraining. This program type of assistance actually can max out $36,000 or 36 months. So you see the difference. When the short term is a max of 18 months. The long term is a max of 36 months. The months of assistance is based on when you are going to graduate from your program or when you're going to complete the program you're enrolled in. If you're enrolled in school and it's only a 2-year program, you are only going to receive 24 months of assistance. You're not going to get the full 36 or 36,000, whichever comes first, as far as the money or the number of months. So, again, if you enroll in a 2.5-year program, which is 30 months, then you're only going to receive 30 months of assistance, capped off at $36,000 is the dollar amount. And then hopefully when you finish school, you will have employment, so that way you'll be able to resume the payment from the state and take back over to your mortgage company. One-time assistance is for individuals now who have fully recovered. So you experience a qualifying hardship that was in the past, and you experience a qualifying hardship that was in the past. It could be unemployment. With the unemployment scenario, let's say you got laid off, you received unemployment, now you're back working, but you're behind several payments and you can't catch up. This is a perfect example to where you would qualify for reinstatement. Reinstatement would bring the mortgage fully current for you and pay it ahead one payment, and then you resume the payment. This program, the reinstatement program, is only set for individuals who have now recovered from their hardship, meaning they're back working full-time, have the ability to resume payments, they just can't pay the past due amount. And so they will pay any past due portion, meaning first mortgage, second mortgage, taxes, insurance, anything that's related to the mortgage expense. Another benefit of this program is that if you are in foreclosure and your lender is pursuing foreclosure activity, once you submitted a complete package to my agency and we have uploaded it to our state and they determine that you meet eligibility, they will place a stay of foreclosure on the file. That stay of foreclosure will remain in place for 120 days to allow our state agency to underwrite your application, make a decision, and if they approve your loan, then you're fine. They remove the foreclosure, you're brought fully current, and then they make the payment. If you are denied the loan application, then what happens is they lift the stay, and your lender can then pursue foreclosure activity with you. Again, just so I can restate it, the stay of foreclosure is not placed on your file until the application has been accepted by our state. It doesn't mean you've been approved. It just means all the documentation is there on file. They reviewed it. Everything that they need to make a decision is there, and now they're going to underwrite the case. Once that's done, they'll place the stay of foreclosure, which will prevent the lender from foreclosing or moving forward with the sale date on the home to buy our state enough time to actually make a decision. Another benefit of the program is the forgiveness period. So you know there's a forgiveness clause written into the loan application. What happens is after the term was 10 years, so after the first 5 years, the loan is prorated. In this example, the homeowner received $20,000 that went towards their mortgage. After 5 years, the principal balance automatically reduces by 20% each year, beginning on the 6th year. So he received $20,000. By year 6, he continued to follow the terms and conditions. The money that was paid for him automatically was reduced by 20% and it went down to $16,000. The next year on his anniversary date, another 20% was reduced. The next year, another 20, and so on and so on. So by year 10, the total amount of money that was forgiven is the entire balance. So this is how the loan can be forgiven, where you will not have to make any payments if you follow the terms and conditions. And there's a slide that we'll go over later, which will explain that in more detail. For the closing process, if you do get approved for this loan application, our state housing agency will need up to 30 days after the loan closing to process and disperse your initial payment. Once you close the loan here at my agency, we will get all the documents prepared, uploaded back to our state. Once that's done, generally it takes 30 days from that point, before the payments are actually applied to your lender. Also, the next bullet that you see is the North Carolina Housing Finance Agency provides money directly to the servicers, tax collectors, insurance agencies, HOA providers on your behalf. You do not get the money. My agency does not receive any of the money. All of the money goes directly from our state housing agency, from the U.S. Treasury to our state housing agency, directly to your mortgage providers. So whoever they are, they're going to get the wire transferred directly to them. We do not see any of the money transactions. Some basic reminders for the homeowners after you submit the application. You want to continue to make mortgage payments during the waiting time in case you're not approved for the MPP program. So even if you're not approved, remember, you're still responsible for making your payment. There's no guarantee that you're going to be approved for this program. However, if you have a one-on-one or if you speak to one of our counselors, we will and can go in more detail with you regarding what we feel like your chances are, or if there's any red flags that we see before we actually submit the application over to our state housing authority. So how long does the process take? Generally, between 45 to 60 days. Why does it take that long? Because it's a manually underwritten process. You have several different departments that will review and analyze your file and your package. So you have my agency, which is the front side. We have to prepare it, get it submitted to the state. You have a reviewer, and then you also have an underwriter. You have a legal team. You have your financial institution. You have a closer and a processor. So all those different individuals have to review that package before you will come back to a closing. So with that being said, generally the timetable is 45 to 60 days. There's no definite time that we can put in, write down on paper, simply because it is a manually underwritten process. Some applications are done in less than 30. Some applications are very, very quick. Unemployment scenarios or hardship cases are generally the fastest to underwrite. Those are generally done in less than 30 days. All other hardship scenarios, because it takes longer to verify the hardships, those generally fall between 45 and 60 days. And then, of course, the more documentation that we have, the longer time frame it's going to take, because it's more paperwork they're going to have to review. So just so you know, again, the timetable is open. This is just an estimate of me saying 45 to 60 days. Okay? If you do have automatic ACH mortgage payments being drawn, just as a reminder, at the loan closing, if you're approved and you come to closing, that's something that we will remind you to take off, because the bank will continue to draft those payments from you. So let's discuss one question that you might be thinking of. What's some of the risk, the tax liability, if any? From the homeowner's perspective, there is no real liability with this program. The one thing that you will not be able to do is claim the interest that the state is paying for you. So you're going to get a separate 1098 form at the end of the year. Any payments that you've already made to your lender year to date, you will get credit for. You will get a 1098 directly from your mortgage company, which will show the interest and the payments you've made. You will also get a separate 1098 from our state housing authority, which will show you the payments they've made on your behalf. And with those payments they made on your behalf, it will also show no credit going towards interest. So the same process that you normally would do when it comes to filing your income tax, that stays the same. The only difference is if you were to receive the max amount of money, and if they paid the entire year worth of mortgage payments for you, then, you know, at the end of the year, you're not going to get any interest credit back on your 1098 from your mortgage company. So it's not going to show that you made any payments. All right. So how do you avoid repayment of the loan? Right now, it probably seems too good to be true. Free loan, can get my mortgage payments paid. How do I get it? How do I sign up? The process is not that hard. It's actually fairly simple. What do I got to do? How do I, if I have to pay any of this money back? So how do you avoid repayment? First thing is living in the home 10 years from the date of closing. Do you have to stay in the house 10 years? No, you do not. However, if you do not live in the house 10 years from the date of closing, then they will require you to pay a portion of the money back that you received. So if you sell the house, then that money is going to come out of the sale proceeds. If you decide to rent it, then they're going to ask you to start making payments. So again, if you live in the house 10 years from the date you received the loan, then the loan will be forgiven. Next thing is you will have follow-up housing sessions. Those are done over the telephone. They last about 5 minutes. Generally, you have 4 to 8 sessions during the time frame you're receiving the money. Those 4 to 8 sessions cover simple questions. There's 7 questions that we have to ask you regarding: are you working? Are you not working? Are you still in school? Have you completed a loan modification? Are you still receiving unemployment benefits? Have you experienced any type of new hardships? Simple yes/no questions is all we're going to cover. You must complete those housing sessions. If you do not, or you fail to complete them, then they can stop the program. You must also notify the counseling agency if you find employment. What happens is your income will determine if you still meet eligibility. So if you find work, that does not mean the program stops. It also doesn't mean that you have to start making payments. What they're going to consider is they're going to look and see what your new gross income is and if you still meet the eligibility piece. But you're responsible for making sure you notify the housing agency if you find work. Also, you must continue to search for employment. One of the questions that they're going to ask you is, are you looking for work? If you say no, then that triggers that you now have the ability to take over the payments on your own. So they're going to ask you for proof of income, and more than likely the program will stop. You must also notify the housing agency if your mortgage expenses increase. This program pays the mortgage company directly, but because it is a third party, your mortgage company does not provide information to us. They provide the information directly to you. So you're still going to get statements. You're still going to have all the same access as you did have before, but you're responsible for making sure that if the payments go up, we're notified. Otherwise, we do not know to send in the correct amount. And if we don't send in the correct amount, then your lender says you're in default. And if your lender says you're in default, then they can move forward with foreclosure. So it's very important that you notify us if the payment increases. So these are the 5 major points which you must follow to avoid repayment of the loan. Living in the house 10 years, making sure you complete the follow-up housing sessions, continuing to search for work while is one of the questions, notifying the counseling agency if you find work and if your mortgage expenses increase. So again, if you have further questions, my contact information will be on the end of the slide, so you can email me or give me a call. There's another program which is a second mortgage refinance program. This program is only available for individuals who have a second mortgage and who no longer afford it, but you must be working full-time. This program can actually refinance the second mortgage with a 30-year, zero interest rate and defer all payments. For those of you who actually do have a second mortgage, I would recommend that you email me with your questions just so you don't get confused with how the first program works. If you don't have a second, then just bypass this slide and move on to the next one. All right, so just some quick information. The main questions that come up when we do the PowerPoint, how much does it cost? It's free of charge. If you go through our agency, there's no cost involved. We are a HUD-approved nonprofit housing agency, and we do not assess any fees or charge any expenses regarding assisting individual homeowners for this program. Do I have to be delinquent to receive assistance? No, you do not. Again, you can be current, you may be behind. Your current status is not, may or may not impact your eligibility with this program. So please get that. Don't let that deter you from wanting to try to apply for the program or try to get assistance. I have bad credit. Will I still qualify? Possibly yes, because remember, the program is not based on your credit score. It's based on your payment history with your mortgage company, and that's only prior to the hardship date. So that's the only thing they're considering is they're looking at the 6-month window prior to the hardship date. So again, you can have a low credit rating, has nothing to do with your credit score. Also, another thing is that this program does not report to the credit bureau, so it's not going to have any impact on your credit rating. It can help you if you're delinquent, because one thing that's going to happen is now you're going to get consistent on-time mortgage payments being applied to your mortgage company. The last common question that we experience is, if I find a job, will I have to pay the money back? No. If you find employment, one of the terms and conditions was that you must notify our housing agency. If you notify us and advise us that now you're working, what the state is going to do is they're going to look at your income and determine, do you make enough money to pay the mortgage on your own? If it's determined that now you make enough money to pay the mortgage on your own, the state will award you 2 additional months to give you enough time to get back on your feet, and then you resume payments directly to your mortgage company. You do not have to pay the money back to the state as long as you continue to follow the other terms and conditions. Now, if you find work and let's say that you're making less money and you still need our assistance, what they will do is you will have to complete an action plan. Once you complete that action plan, send in proof of your income, and if they approve the action plan, they will allow you to work at the job, and any remaining payments you still have left on the loan, they'll pay to your mortgage provider. So it's a win-win for both parties. You can still work and you can still get assistance if you meet eligibility pieces. Now, if you do not advise our agency that you're working and the state or our agency finds out later, then it's very likely that they would disqualify you from the program and you would have to pay the money back. So, again, it's very important that you just notify us that you're working and everything should work itself out. The link that I have on here is a link directly to the FAQ page for our state housing agency, with the North Carolina Foreclosure Prevention Fund program. So again, if you have more questions or something that you want to just kind of look up really quick, you can go to that link directly, and that should be able to answer them for you. Again, my contact information is going to be later on in the PowerPoint, and that way you can contact me as well. All right, so now since we went over the state program, hopefully that should give you a very good idea of how everything works. The next thing we're going to cover for about 15 minutes is the Make a Home Affordable program, which is a federal program. Again, this is where you're looking at modifying the mortgage, changing the terms, getting a lower mortgage payment, trying to get a lower interest rate. State program doesn't do any of that. All it's doing is just making mortgage payments for you. This program does not make the payments. However, you can see a significant decrease in your interest rate or possible mortgage payment, which makes it a lot more affordable for you. All right, so some of the things that the Make a Home Affordable program includes is refinance options, MHA, HARP, FHA refinances, repayment plans, forbearances, modifications, and disposition options, which I'm going to cover with you really quick. So, with the loan refinance options come into play when your property is underwater. So if you're experiencing a situation to where you've been able to consistently make your mortgage payment, however, your property now is underwater, is the term that we like to call it, to where it's at 80%, greater than 80% of your property value, then you may be eligible for a HARP refinance, which is Home Affordable Refinance Program, or either an FHA refinance, where they can look at refinancing the property to get you into a more affordable interest rate. This way they kind of set aside your loan-to-value percentages, but this is for a situation of someone who has been able to afford the payment, except your property now is no longer the value. You've got a drastic decline in the property value, or you're upside down or underwater. You have repayment plans. Repayment plans, just so you understand what they are generally structured with the lender. If you have displayed that now you can afford the payment and you have a slight surplus in your budget, then most lenders will want to do a repayment plan with you to where they increase your mortgage payment for a certain number of months until you're fully current or caught back up. Again, with all the programs that we're discussing, we help you with all this when we're looking at working with the state, or i.e. working directly with your mortgage provider. So again, we'll have you complete the packet, we'll analyze it, and we'll discuss everything with you before we submit it. Forbearance agreements. Forbearance agreements are set for individuals who are generally less than 90 days delinquent. And again, this is working with the bank. So if you don't qualify for the state program per se, then may look at trying to see if we can do a forbearance agreement with your mortgage company. With the forbearance agreement, generally you can be no greater than 90 days delinquent when you're applying for it. What's going to happen is the bank will reduce or suspend your payments for generally 3 to 6 months. In some cases, they can reduce the payments for a maximum of 12 months, which will give you time to pay the reduced payment, and hopefully within the time frame they allot, you'll be able to find work. So they'll reduce the payment generally between about 30% is what the payment will be based on your gross income. And that new affordable payment, you will just have to pay that for the time frame they allot. And then again, once the time frame is up, then they'll consider you for modification if you're working at that point. So this is a temporary solution for individuals who are delinquent less than 90 days. Loan modification is more permanent. This is where individuals are looking for a long-term and more of a permanent hardship. A hardship could be a drastic decline in income. You were working, had a job loss, now you're working again, and you've had to take a pay cut of 20 or 30%, whatever the percentage is or may be. Again, this is for permanent hardships and where you actually have stable income coming in. So what you see on here under qualifiers, most mortgage companies use 31% as their hardship ratio. So what they're looking at is they're looking at your gross income. So whatever your gross household income, multiply that by 31%, and that is the target payment that your mortgage company is trying to get your mortgage payments down to. So if your gross income is $3,000, then 31% of that is $930. So that's what the mortgage company is actually looking to get your payments down to. So again, just make sure that the numbers, the numbers always have to work. So for the sake of this example, we're just going to round that and say 900. So the mortgage company is trying to get the payment down to roughly $900. How they do that is included under modifications include, it's called a waterfall effect. The first thing they look at doing is capitalizing your arrears. They take your delinquent money and they put it to the back end of your loan. So now you're fully current. Now that you're current, now they can look at reducing the interest rate. Now the floor, which is the bottom, the lowest rate they can offer you is a 2%. It doesn't mean they're automatically going to offer you 2% because remember, they're trying to get you at that 31% of your gross income. So in the example, we use $900 was the target payment they're trying to get. So if they reduce the rate and you had a 6 and now they go to a 5, and 5% can get their payment down to $900, then that's what your rate will be. If they have to continue to drop it so they get to the 2%, then that's what your rate will be. So it just depends on where you are as far as the numbers making sense and matching for the lender. If the 2% rate, if they lowered it to 2 and it still doesn't work, then what they can also do is they can extend your term to 40 years. The 40-year term, again, they add years to be able to spread the payments out to make the payments more affordable. Hopefully that will work for you. If that doesn't work, they can also defer some of the balance and allow you to only pay on a portion of it for the first term, and then once that's completed, once you pay that off, the second portion will come due. Generally, this is what most banks are going to offer you. If they're going to do a loan mod or willing to do a loan mod for you, then this is how the loan modification side works. So they're looking at 31% of your gross income. Whatever that number is at your gross income, that's the target payment, which must include your principal, interest, taxes, and insurance. And so the modifications include the waterfall effect. That's how they're able to get your payment. Now, if you have no income coming into your household, it's very unlikely they're going to do a modification because they have nothing to work with as far as being able to offer a permanent solution. They may offer the previous slide that we went over, which was like the forbearance agreement or some type of temporary workout solution, but nothing on a permanent level like a loan mod will offer you. All right, so let's talk about some disposition options. So disposition options happen to where everything is denied. The lenders are saying, hey, I'm not willing to offer any type of solution. Maybe we tried the state program and the state program denied us as well. So what's going to come back is a short sale or possibly a deed in lieu. What a short sale is where the bank says, I'm willing to accept a lower bid on the house than what you currently owe me. When is a short sale beneficial? A short sale is beneficial simply because it works better than going through foreclosure. If you go through the full foreclosure process, one, it's going to damage your credit. Two, you possibly can be taxed at the end of the year for any deficiency balance. So let's say you owe $150, you sold the house for $125 in the foreclosure sale. The lender could tax you for that $25,000 as a 1099. In the event if you get an approved short sale, with a short sale, you're listing the house with a real estate agent. The real estate agent finds buyers. The buyers in turn make an offer, and the bank accepts it. If the bank accepts it, that offer, whatever the difference is between that accepted offer and what your current balance is, the bank will waive it. Also, some banks will also give you relocation money, generally between $2,000 to $3,000 to help you with relocating. All this is for an approved short sale. Now, if that's something that you're interested in, then of course you need to also let our agency know, and we can help you with that. With a deed in lieu, that's just a transfer of titleship where you pretty much just signing the house back over to the lender. Again, most banks are not doing deed in lieu because they want you to try to sell the house first, which is the short sale route. So those are the two main disposition options when the banks are saying everything else is denied, or they will be willing to offer you. Some quick FAQ information for loan modification. How much does it cost? Again, it's free as well. These programs are no cost to you. We will help you with the packages and get everything submitted. We work directly with the lenders or directly with the state agents and get all that documentation uploaded for you. Do I have to be delinquent to receive assistance? Same as the state program, you do not. You may be current, you may be delinquent. Your current status, as long as you have a qualifying hardship, then we can look at your case and look at trying to submit your information. I have bad credit, will I still qualify? Again, credit score does not matter in most programs with a loan mod. However, if you're trying to do a refinance, then yes, they will look at your credit rating when they're trying to do the refinance. What comes into play there is just your loan to value percentage. Something that's very common, I applied for a loan modification and was denied. Am I still eligible? Yes, you may. They've recently made some changes for the Make Home Affordable program, and so if you were denied in the past, then you are still eligible to apply based on what your hardship was and how soon you were denied. Same thing goes for I'm currently on the loan modification now. Can I still apply? Yes, you can. Like I stated, they recently made some changes to the Make Home Affordable program. So please, if you're experiencing some type of hardship, make sure that you fill out the documentation correctly, get it over to us so we can work with you. At the bottom is another link for some FAQ information for the Make Home Affordable program that can actually help you. So today we went over the state program, which is the North Carolina Foreclosure Prevention Fund, and we went over the Make Home Affordable program. Both of those have several components to them, so there's multiple options underneath each one, which the main thing is filling out the documentation, and then that way we can evaluate your case and see what's going to be the best option for you. Hopefully the PowerPoint that you listened to today gave you some insight on how they work, understanding the programs, and what you may or may not be eligible for. So on here, some of the homeowner responsibilities we ask for: patience, commitment, and being responsive. One is because everything is a manually underwritten process. So we're working with you on submitting the packages to your lender or either to the state housing agency to see which options are going to be best suitable for you. And we don't make any final decisions. So again, we understand time is not our best friend right now. However, we have to be patient and understand and wait until those decisions are made and any updates are given to us so we can pass it on to you. We want to make sure that you're committed and being responsive, because at the same time, there's a lot of clients that need assistance, and when the documentation is needed or someone is asking us for the documentation, we need to make sure that you get that over to us as quickly as possible, so that way that can help you with getting an outcome faster. And being responsive is very key. Please make sure you return phone calls or give us updates on information. you change your mind on a situation, or you would like to go with a different route, or if you're having problems with trying to get documents that we actually need. There may be another way or some resources that we can help you with. All right, so each one of you, there are packages that's online, and you should have received it through email from our intake specialist. If you go online to our website, you can download our mortgage assistance package and our hardest hit fund package. Actually, the mortgage assistance package is required for you to receive assistance so we can start working with you. Again, that's on our website. You can find that under our mortgage, North Carolina Foreclosure Prevention Fund, and also under Make Home Affordable. It's located in both locations. So please, if you please get that packet if you haven't received it through email yet, so that way you can go ahead and get it completed, get it sent back over to us. Any questions that you have regarding this PowerPoint, please contact myself, Demario Stanley, at mstanley@choedc.org. My office number is 919-241-4718, extension 23. Emails, I will try to respond to you as soon as possible. So, again, any questions, any concerns, email is the preferred contact method. So please do so. And hopefully this workshop or this PowerPoint helped you out in a lot of ways. And I look forward to working with you. Thanks. Have a good day. Testing 1, 2. Testing 1, 2. Testing 1, 2. Testing 1, 2. I can't believe I just did all that talking and it didn't get recorded. Are you serious? Testing 1, 2. Testing 1, 2. Testing 1, 2.